Hey everyone, and welcome back. So in my latest video that I posted a couple of days ago, we went through and spoke about some of the top stocks that have been purchased by the super investors in the latest financial quarter. And the reason why that we are able to go through and see what stocks have been traded, what have been bought, and what have been sold by these great investors is because of the 13F SEC filing, which is a filing that big institutional investors who manage more than $100 million of assets under management, they are forced every quarter to report what trades they have made in the previous 3 months. And first of all, thanks to everyone who watched and engaged with that video. It was very well received. And as a follow-up to that video, I thought we could dive deeper into some of these other 13F filings. And today in particular, we're going to be taking a look at Michael Burry. And the reason why I wanted to start with Michael Burry is because in that previous video, we were able to talk about some of the bigger companies that super investors have been buying into. But a major thing that video missed was options contracts. That video only included stocks that have been held directly by super investors. And people like Michael Burry have portfolios that are mostly made up of options contracts rather than direct ownership of businesses. Options contracts, for those who are unaware, are essentially a way for investors to make short-term bets on stock price movement. So you have two major types of options contracts: call options, which are essentially bets that a stock will rise in the near term, usually a few months or maybe a year at the most, or 2 years. And put options are the other type of options, which are a bet that the stock will go down in the short term. And Michael Burry has been one of the most active options traders out of the super investors, making some massive $100+ million bets on some stocks going up and some stocks going down. In the title, you can see that one of his biggest bets is that Tesla will go down in the short term. But there's also some interesting bets in terms of call options, stocks that he believes will rise in the future, and that is what I want to get into in today's video. So today I'm going to be breaking down all of his options trades, which, as I'm about to explain, represent the vast majority of his portfolio. So this is really where he's investing his money right now. I'm also going to talk about the broader implications of the bets that he's placing, because while it is of course interesting to look at each individual bet, if you step back and look at them as a group, there's something clear that Burry is predicting will happen in the markets in the near term. So we can talk about that. And then of course I can give my opinion on some of his individual trades, as well as the overall sentiment that Burry has about where the market is going in the future. As always, if you do get some value out of today's video, I would very much appreciate it if you leave a like on the video, and make sure you hit that subscribe button if you want to stay up to date with content in the future. In particular, over the next week or so, I'll be releasing much more content around these 13F filings and the trades and portfolios of big investors. So if you want to be up to date with all of that over the next couple of weeks, then make sure you are subscribed and have notifications turned on. But with that said, let's jump into the video. Now, as I explained briefly just before, there are two major types of options contracts: call options and put options. And in this particular video, I'm not going to be going in depth and explaining how options contracts actually work and the different types of trades that investors can make with them. But at a very top level, a call option is the right to buy a stock at a fixed price over the short term, over a fixed period. And that basically translates to mean that if you're buying a call option for a stock, you're betting that it will go up. And on the other side, you have a put option, which is the right but not the obligation to sell a stock at a fixed price. And what that means in reality is that you're making a bet that the stock will go down in the short term. And if you're interested in hearing me actually talk in detail about how options contracts work and actually how investors use them to protect their downside as well as to generate income, then I suggest you check out a video I made recently around Phil Town's 13F filing, because he was also involved in using put options. So I spoke a lot more in detail about how these option contracts work in that video. So I'll leave it linked down in the description below. So feel free to check that out if you're interested. In Michael Burry's case, for his fund, Scion Asset Management, stock options actually represent the vast majority of the trades and what makes up his portfolio. To be specific, 93% of his stock market assets within this fund are held in options contracts, either put options or call options, with the remaining 7% being direct ownership in stocks. And as I go through all of these contracts, call options and put options, It's important to keep a couple of things in mind. The first is that we have no idea what price, what strike price these contracts have, and what that means simply is that we don't know whether Michael Burry made money or lost money on a lot of these trades, particularly because some of the stocks that he has bets on or had bets on at the end of the quarter have fluctuated wildly during the quarter. So we have no idea whether he is in the red or in the green or whatever. And the other thing is we also don't know when these contracts expire or whether they're still active, right? So these contracts usually have an expiry date that's maybe a few weeks out or a month out, but that can also go up to a year, 18 months, or even 2 years in some rare cases. So we don't know how long these bets are, whether, say, for example, he's betting that Tesla will go down in the next week, or whether it's in the next 3 months or the next year. And the other thing is we're looking at this 45 days after the end of the period. So we have no idea if they have expired, whether he's executed some of these contracts and actually bought stock in them, used those contracts to get a direct ownership in some of these businesses or to sell some businesses, or whether he's just sold these contracts to somebody else. So that's something to keep in mind when we're going through these options. So starting with the call options, which again means that he's making a bet that these stock prices will go up in the near term. He actually had 7 different call options that he either added to or were brand new positions. 4 of them already existed, but he added to them. And there were 3 new options contracts with different businesses, different stocks that he initiated during the quarter. So starting from the top, we had Facebook, which was the largest bet. The bet represents $327 million worth of Facebook stock and 15.7% of his portfolio. And he had already made this bet, but he actually increased it by 71% during the quarter. Next, we have Google stock, which represents $230 million worth of Google stock and also 11.1% of his portfolio. And this was a bet that he had mostly made in previous quarters. As you can see, he only increased it by 14%. So the vast majority of this bet was already in place. We then have $58 million worth of Kraft Heinz contracts representing 2.8% of the portfolio and increased by 21%. And finally, CVS, which was $44 million, representing 2.1% of the portfolio and increased by 31% during the period. And then in terms of new bets, we had McKesson Corp, which represents a $130 million bet for 6.3% of the portfolio. He had contracts for Walmart representing $54 million, representing 2.6% of the portfolio. And finally, Cardinal Health, $49 million, representing 2.6% of the portfolio. So in Michael Burry's case, he had some significant call options, bets on stocks going up in the near term that already existed in the portfolio, but he added considerably to some of them, Facebook in particular, increasing it by 71%. And it is now his largest bet in terms of call options and the largest position in his portfolio, but he also added to some other ones that represent a smaller amount of his portfolio. More interesting, at least to me, and I'm sure to a lot of people, are the bets that he's making against stocks, which he does with put options contracts. In terms of put option contracts, there were 3 in total. There were 2 that he already had that he added to, and then 1 brand new bet using put options. So for the 2 that he added to, the first is of course Tesla, and this bet represents $731 million worth of Tesla stock and represents 35% of the portfolio. It's the largest position in his portfolio. And he already had this bet, but he increased it 34% during the period. The second that he added to was LTL, which is the iShares 20+ year bond ETF. This one represents $280 million worth of this ETF and is 13.5% of his portfolio, increased by 53% during the period. And then the one new put option bet is against ARK Innovation ETF. The bet represents $31 million worth of the ETF and is just 1.5% of the portfolio. That last ETF, the ARK ETF, is of course this bleeding edge ETF run by Cathie that includes a lot of high growth businesses I'm not particularly interested in investing in because most of them are not profitable yet and they have massive valuations with massive expectations for the future. But if you're wondering what might be made up in this ETF, well, the biggest position that represents, I think, 10% of this ETF is Tesla stock. So this is kind of another way that Michael Burry can bet against these high growth businesses, but also contribute to his bet against Tesla. So what does all of this mean? What do I see when I'm looking at these bets? Do I see anything, see any patterns between some of these investments? Well, the first thing that I've noticed is that 75% of the Scion Asset Management portfolio, Michael Burry's portfolio, 75% is concentrated in 4 bets. 2 bets that are long, 2 call option bets that are betting that these stocks will go up, and 2 put option bets, 2 short bets, betting that those stocks will go down. The 2 long bets are Facebook and Google, and Facebook and Google combined currently represent 90% of the digital advertising market. So a bet on those 2 businesses over the short term is some kind of bet that is basically in the digital advertising market. And to some extent, I certainly agree with this. I'm an investor in Facebook, so I certainly agree with betting on Facebook. My view is just that I very much care about Facebook over the very long term. In terms of what happens to it over the next few months, I have no idea. But certainly I agree that the digital advertising market is going to continue to grow, probably at a very considerable rate, probably at double digits for a very long time, as people, as advertisers, as businesses move their advertising dollars away from traditional means and into these businesses. And Facebook and Google are in perfect position to capture the vast majority of new revenue that comes into this industry. And then on his short bets, the bets against Tesla and treasury bonds, they are very much a bet that inflation will get higher, that inflation will go up, and that as a result, interest rates will go up from that, and that will cause a decline in the price of treasury bonds, long-term treasury bonds, as well as probably crush businesses that have really high valuations, that are high growth speculative companies like Tesla. Inflation is currently the #1 issue that is plaguing investors. Inflation this year in 2021 is likely, it's looking like it's going to be between 5 and 6% on an annualized basis, which is much higher than the 2 to 3%, which is acceptable. So the question really is, how much of that is transitory? How much of that is being caused by supply constraints, supply chain issues that will go away over the next year? And how much of that is just caused by, let's say, monetary inflation from all of this stimulus that is coming from the government and also from the Federal Reserve printing money and basically loaning it to the federal government? And if inflation gets worse from this point onward, or even if it doesn't get worse, but it stays above 3%, it stays above that 2 to 3% range that the Federal Reserve is looking for, then we would expect to see the Federal Reserve react by raising interest rates. And the raising of interest rates means that treasury bond yields will go up, and that basically means that their prices will go down. The other effect that interest rates has is on stocks, particularly growth stocks, because the way that stocks are valued is the present value of discounted cash flows, basically. And within that discount rate, within the rate that you're bringing back cash flows to the present day, is going to be some kind of treasury bond component, whether it's entirely treasury bond or whether it's a smaller component of that discount rate. But regardless, institutional investors, which move the vast majority of money around in the markets, they will be discounting stock prices at a higher discount rate as interest rates go up. And the result of that is bad for all stocks. It means all valuations go down, but particularly for businesses where the vast majority of cash flows are expected to come many, many years down the road. So for businesses like Tesla, where people are expecting the business to continue to grow at 40, 50% per year for an extremely long period of time, the vast majority of benefit that investors expect to gain in terms of profits is going to come 10, 15, maybe even more years down the road. And those cash flows, because they are being discounted back so many years, are extremely sensitive to interest rate changes. And as a result, it's usually high-flying growth stocks, speculative businesses that get crushed first when interest rates go up. So what do I think about all of this? Do I agree completely with Burry? Certainly, I don't agree everything with what he's saying, but I certainly agree with the idea and how the mechanics of that. Tesla is extremely fragile to interest rate changes. So if we are to see runaway inflation that needs to be stopped with higher interest rates, businesses like Tesla, everything will get hurt, but businesses like Tesla in particular will get destroyed in terms of their stock price. And there will be other businesses that get hurt fundamentally because they have too much debt. But then the question is, do I think that I know whether runaway inflation is coming or whether the inflation will go up in the future, or even just the basic question of what inflation will do in the future? And for that, I don't know. Macroeconomics, I think, is something that is either extremely difficult to assess, but even in some circumstances, I think it's impossible to assess because there are just way too many factors that go into whether inflation goes up, down, or sideways, or to what magnitude. And as a long-term value investor like myself, it also doesn't really matter what happens. I'm looking to invest over the next few decades. Over that time, I'm sure there will be periods where inflation is high. There'll be periods where it's low. There'll be periods where interest rates are higher. There'll be periods of weak economic activity and recessions, and periods of booms, and periods where certain industries are struggling and other ones are doing well, and vice versa. There will be changes in business environment conditions in the macroeconomics over that period. But investing through that period it really doesn't matter what happens in the short term, right? It doesn't matter if we go into a recession over the next few years. It doesn't matter if inflation goes up over the next few years. As long as you're investing in really great businesses and buying them at appropriate prices, not willing to pay any price, then if we don't see inflation, the businesses in my portfolio will do well. If we do see inflation and stock prices come down as a result of that, I will happily invest more in really great businesses that I know will thrive regardless of the economic condition. So that's all for today's video. I hope you guys got some value out of it. I'd love to hear your thoughts down in the comment section below. As always, I've enjoyed, particularly over the last couple of videos, engaging as soon as this video goes live with you guys, answering questions and seeing what opinions you have on everything that we spoke about in the video. But with that said, hope you guys have a great day, and I'll see you in the next video.